I don't think we've seen the full impact of what the first half of this year is ultimately going to do to the real estate market. You're starting to see the number of home sales slide. This is partly an indication of the tight inventory, but even the inventory numbers are starting to shift a bit here. One of the things that I think is a very prevailing narrative for anybody who's bullish housing, oftentimes that's driven by a bias, whether it's someone in the real estate market or someone making investments that are long housing. The inventory narrative is one that is often leveraged. And what's interesting is when you really peel back the layers and look at the data, per capita, the housing supply right now is the same as it was in 2008. We really do not have a housing supply shortage. What's ultimately come of the housing market is it's become more regional than it ever has been because of this new gift of mobility that most people have benefited from since 2020. So people are moving to the markets that make the most sense, whether it's affordability, low taxes. You're seeing most of the migration happen to low tax states and states with more preferable climate, Florida being one of the greatest beneficiaries of that. So it's really hard when you're looking at the data in aggregate, when you're looking at the national numbers on some of this, it doesn't always tell the full picture. And depending on who you are and where you are, the information that you're seeing could greatly conflict with what you're experiencing in your local market. Florida being a great example of that, as I think going into the second half of this year, housing is going to come under some notable pressure. And markets that aren't benefiting from migration, particularly for tax reasons and lifestyle reasons, are going to probably see a pretty drastic drop in home prices. And the first sign of that is the decline or the rollover in the volume, the number of homes that are being sold. So this is some things for you to keep an eye on. Don't get caught up in this inflation narrative. Don't get caught up in the supply narrative. Pay attention. Things can change very, very quickly. When you have interest rates on mortgages specifically, spike as dramatically and drastically as they have this year, that is ultimately going to have knock-on effects. You're also seeing, because of inflation, the wage growth and personal income or income expenditure declining or being negative year over year. That one might argue is because of this high inflation rate, but ultimately that's the impact or the psychology that the consumer feels when they're making $1 and inflation makes it feel like 50 cents. They're going to spend that much less, whether it's just normal consumption or to go out and purchase a home. And with interest rates doing what they have done, it's making home affordability more complicated for most people. And speaking of narratives, the prevailing narrative when it comes to interest rates is that the Fed is going to continue to hike. So let's talk about this, because for someone like me who lives and breathes the bond market and mortgage rates and how all of this works and how the flow of capital, the flow of money, and the underlying cost of money, which is the interest rate, really, really works. Most people don't understand or can't yet conceptualize this because they follow mainstream media narratives, which is the Fed is raising rates and therefore that's going to continue. And you look at the drastic increase or spike in mortgage rates, and that means it's only going to continue because the Fed is raising rates. This is generally the complete opposite of what is true. Historically, whenever the Fed goes into a rate hiking cycle like they're in right now, of course, they're more aggressive than they historically have been because of the much hotter inflation prints that we've been experiencing. But when the Fed hikes interest rates, typically this leads to lower mortgage rates. And the reason is because mortgage interest rates are not controlled by the Federal Reserve. That is outside of the situations where they're doing quantitative easing, buying mortgage bonds, and suppressing interest rates that way. But we'll get to that in a second. But before we do, let's focus on this idea that the Fed raising the Fed funds rate, which is an overnight lending rate, means mortgage rates are going to go higher. When in the reality, the tail wags the dog. The market already did the tightening for the Federal Reserve. The fight against inflation has already been underway by the market itself. That's why you see interest rates where they are on mortgage rates, not because the Fed raised the overnight lending rate 75 basis points or 0.75%. That's silly. Mortgage rates are a reflection of the market sentiment in the bond market. The bond market does not like inflation. It erodes the principal value of a bond, hence bonds selling off dramatically. The interest rate or yield on a bond is inverse the price. So as investors were dumping bonds the last 4 or 5 months, that caused interest rates to spike dramatically. We're now getting to a point where that jump in interest rates, the slowing of the economy and other types of factors, partly because of inflation and the impact inflation has on real wages and the way people feel about their economic situation. You're seeing spending decline. You're seeing inventories grow, which means ultimately things on the shelves are going to come down in price because of the lack of consumer spending. When you're seeing all of these things work together, eventually the economy is going to contract. And because of the high inflation, Q1 of 2022 had a negative real GDP print. It was negative 1.5%. Now, recession is defined as 2 consecutive quarters of negative GDP. The Federal Reserve, specifically the Atlantic Federal Reserve Bank, puts out a data set. It's called GDP Now. It's a forecasting model. This was showing a slowing GDP in Q2, but nothing negative. Literally all the way up until last week. It was at least positive until Thursday when it was basically flat. Friday, welcome in the end of the quarter and the GDP Now forecast being updated for the end of that quarter, and it showed a massively negative 2% forecast for Q2. So semantically speaking, it most likely means that we have now 2 consecutive quarters of negative GDP. That means we are officially in a recession. But waiting for that data to come out, waiting for someone in government or central bank to tell you that you're in recession is investing and thinking in the rearview mirror. Okay, we are already living through that recession. We all know it. We can feel it. It's a question of what happens next, or how long does this last, or how deep does the recession go? And these recessions historically have big impacts on housing, and they have big impacts on interest rates, particularly mortgage rates, because as the economy continues to decline and things become uncertain, that is what we call in markets a risk-off environment, and investors will continue to sell riskier assets like stocks in exchange for cash flowing, safer investments like government bonds. So it feels like the data is telling us that inflation as a year-over-year rate of change looks to have peaked and is now in the rearview mirror. So what better time than now? Up until a week and a half ago, the interest rate on the 10-year Treasury bond was 3.5%. So you could get what's considered the quote-unquote risk-free rate at 3.5%, while there was plenty of market uncertainty. Stocks were on a pretty consistent decline. There was really no sign of anything letting up in the crypto market as counterparty risks continue to wreak havoc in that space. So investors started to rebalance, and a 3.5% on the 10-year was pretty attractive. Now you look at the data that came out last week, and that sentiment has accelerated. More and more investors are now jumping into the bond market as a risk-off investment strategy to protect themselves against the likelihood of further downside. As more people are looking to buy a short supply of a particular thing, law of supply and demand, the price of that thing is going to go up. That is what's happening in the bond market. More and more investors are changing their view on the market. They're shifting their investment strategy. They're rebalancing into bonds. That's causing the price of bonds to go up and interest rates to go down. This is how mortgage rates are derived. It is not the Federal Reserve. The majority of mortgage loans are packaged into mortgage-backed securities. The investors who buy into these mortgage bundles, these mortgage securities, receive a bond, and a coupon based on that bond is what the interest they collect every month. There's more technicalities to that. I'll get into it at a later time. But that is what drives mortgage rates. So investors are now competing for a limited supply of these bonds. It's driving the price up. Ultimately, that drives interest rates down. Specifically, that drives mortgage rates down. So I believe we are now in a downward trending path for mortgage rates. I think the 10-year peaked at 3.5%. I think the highs in inflation are behind us. The highs in interest rates are behind us. This is now a risk-off market environment. Housing is going to come under pressure, but in the meantime, you're going to see bonds rally and mortgage rates decline. Will this provide an element of support to the housing market? Because one would argue a big reason that there's weakness in housing, and we're seeing some of these statistics in housing roll over and potentially start to decline, is because affordability has been impacted so much by the spike in interest rates. Well, if mortgage rates start to come down, wouldn't that suggest buyers are going to show up?